Welcome to Global Markets Daily Brief. I'm Jonathan Simkowitz. It's Monday, February 16th, 2026, and we're covering Friday's close. Here's the question I want to sit with today. Inflation came in cooler than expected, and the market basically shrugged. The S&P 500 finished up 0.05%. The Dow added about 49 points. The Nasdaq actually fell 0.2%. January CPI printed at 2.4% year over year, below the 2.5 consensus, with core at 2.5, the lowest since early 2021. Shelter, which makes up a third of the index, rose just 0.2% for the month, a genuinely encouraging number. Energy fell 1.5%. On paper, this should have been a relief rally. It was not. And that disconnect is the most important thing to understand right now. The market's first reaction in bonds was actually pretty clean. The 2-year Treasury yield dropped to around 3.40%, its lowest since 2022. Traders priced in higher odds of more than 2 rate cuts this year, with June looking like the most probable start date. But equities could not follow through. The reason Thursday's 1.6% sell-off in the S&P was still sitting in people's stomachs. What most people are missing about the CPI print is the data quality issue lurking underneath it. Fox Business and several economists flagged that last fall's 43-day government shutdown disrupted the Bureau of Labor Statistics data collection. The BLS used carry-forward methodology to fill gaps in its October and November rent surveys, and that may be imparting a downward bias on shelter inflation right now. When fresh panel data fully rotates in around April, we could see shelter re-accelerate, which would bump headline CPI back up. In other words, the market may be celebrating a number that flatters the trend. My base case is that disinflation is real but overstated by roughly 2 to 0.3% right now due to these measurement distortions. The trade-off is straightforward. If the data is clean and shelter really is cooling this fast, the Fed has a genuine path to cutting in June and possibly September, and that's bullish for rate-sensitive assets. If April's data reveals an artificial dip, the June cut gets pulled forward into doubt, and we reprice all over again. What to watch? The February CPI report in March, and specifically the shelter component. That is the tell. Story number 2 is the rotation underneath the surface, which the headline index is completely obscure. While the S&P went nowhere on Friday, roughly 370 of its constituents actually rose. The Russell 2000, the small cap index, jumped 1.2%, utilities gained 1.5%. Consumer staples added 0.9%. Meanwhile, megacap tech got hammered again. A gauge of the largest tech names fell 1.1%. Amazon extended what Bloomberg called its longest losing streak in almost 20 years. Information technology as a sector lost 2.6% on Thursday alone, and the Nasdaq posted its worst week since November. This is not random noise. This is a rotation. Money is moving out of duration-heavy, high multiple growth names and into shorter duration, domestically oriented rate-sensitive companies. What most people are missing is that this isn't just about the CPI print. It's about AI fatigue meeting valuation reality. The S&P trades at roughly 21.5 times forward earnings, still above its 5 and 10-year averages, but the premium is overwhelmingly concentrated in a handful of megacap names. The Russell 2000 trades around 15 to 16 times forward earnings. That valuation gap is near historic wides, and now you have a macro catalyst, cooler inflation plus falling short-term yields that directly benefit small caps because roughly a third of Russell 2000 companies carry floating rate debt. Every basis point of Fed easing flows almost immediately to their bottom line. Meanwhile, this week's earnings season update from FactSet showed that 74% of S&P 500 companies beat earnings estimates, which sounds fine but is actually below the 5-year average of 78%. Revenue beats are slightly better at 73%. The aggregate earnings surprise is 7.2%, basically in line with historical norms. The market isn't punishing good results. It's punishing anything less than spectacular results at these multiples. Applied Materials was the standout mover. Shares surged roughly 11% on Friday after reporting fiscal Q1 earnings of $2.38 per share, well above the $2.21 consensus. Revenue came in at $7.01 billion. But the real catalyst was the forward guidance.
Management said they expect semiconductor equipment revenue to grow more than 20% this calendar year, far above the street's prior 11% estimate. Q2 guidance was set at a midpoint of around $7.65 billion in revenue. This is genuine AI infrastructure demand showing up in the picks and shovels layer. But here's the nuance: applied materials strength actually makes the broader tech sell-off more interesting, not less. The market is differentiating. Companies with tangible, margin-expanding AI revenue are being rewarded. Companies where AI is still a story about future potential are being sold. That's a late cycle tell. The psychology right now reads a selective de-risking, not panic, not capitulation. Just a deliberate reallocation away from crowded trades. Story 3 is the cross-asset signal that ties this all together, and it comes from the bond market. The 10-year Treasury yield finished Friday at around 4.04%, its lowest since November. The 2-year, as I mentioned, dropped to 3.40. That steepening of the yield curve, short rates falling faster than long rates, is the bond market's way of saying it believes the Fed will ease, but it does not believe long-term growth and inflation are going away. Gold rebounded to around $5,022 per ounce on COMEX, up about 1.5% on the week, recovering some of the violent losses from late January when gold fell 9% in a single session after the Kevin Warsh Fed chair nomination. Rattled precious metals, gold is trying to stabilize, but it's doing so in a fundamentally different environment. With Warsh expected to take over from Powell in May, markets are pricing in a more hawkish structural stance on the Fed's balance sheet, even as they expect near-term rate cuts. That tension, easier on the short end, tighter on the balance sheet, is new and not yet fully appreciated. Crude oil remained range-bound, trading in the $62 to $67 band, with no breakout in either direction. The dollar index was essentially flat on Friday, posting a tiny loss as the softer CPI offset earlier safe haven flows. The dollar is interesting because it's down over 1% year to date, and a weaker dollar combined with lower yields is historically supportive for emerging markets and commodities, yet neither has meaningfully responded. That suggests positioning is still cautious across the board. Now, what would make me wrong? If the CPI data is genuinely clean and not distorted by the shutdown, and if shelter continues decelerating through April, then the Fed cuts twice this year. The 10-year drops below 3.85 and the rotation into small caps and value accelerates hard. In that scenario, you want to be long the Russell 2000 and short megacap concentration. If I'm wrong on the other side, it looks like this. April CPI reaccelerates, Warsh signals balance sheet tightening on arrival. The 10-year backs up toward 4.4 and everything that rallied on Friday gives it back in a week. So let me pull it together. We got a cooler than expected CPI that should have been unambiguously good news, and the market could barely move because it's digesting a week of heavy tech selling and grappling with data quality questions that most people aren't talking about. The rotation into small caps, utilities, and value names is real and may have legs, but it requires sustained proof that rates are coming down, not just one friendly inflation print. My base case is that we're in the early innings of a broadening market where the S&P 500 goes sideways while the average stock actually does quite well, something like a stealth bull market outside of megacap tech. The bull case is that disinflation accelerates cleanly. The Fed cuts twice and the Russell 2000 has a breakout year, closing that historic valuation gap. The bear case is that the CPI flattered the trend. April brings an ugly surprise and the Warsh transition introduces genuine policy uncertainty that represses both stocks and bonds lower. Either way, the next 6 to 8 weeks will tell us a great deal. This is market commentary, not financial advice. I'm Jonathan Simkowitz. If this analysis helped you think about your positioning heading into the long weekend, hit subscribe, share it with your team, and I'll see you Tuesday.